Hi, I'm Whitney Espich, the CEO of the MIT Alumni Association, and I hope you enjoy this digital production created for alumni and friends like you.
Hi, welcome to MIT SEAG webinar. And today our topic is Masterclass in Negotiating Terms. So before I turn over to Rob, who is our speaker today, I just wanted to go through who we are and why we have this alumni group. So MIT Social Entrepreneurship Alumni Group is organized under MIT Alumni Association. And our mission is to build a community around MIT affiliates and friends that promotes and supports social entrepreneurship and impact investing to build a better world. So in addition to doing this community building on our own, we also collaborate with like-minded organizations. This year, our focus has been running webinars. So we've had 4 investor track webinars and 4 entrepreneur track webinars. And this is our last webinar series in this year. Our year is aligned with the academic year. And in addition to having these webinars, we also had co-sponsor webinars with MIT Impact Investing Initiative about career in impact investing and Miller Center GSBI about effective mentoring. And that one was also with MIT Solve. So I hope that you guys have been able to see some of these webinars before, but if you don't, they're all available on MIT Alumni Association YouTube channel. So you can check them out if you miss any of those. So again, as I said, this is our last webinar and our primary programming for this year. We are starting to look at how to go forward for next year. So one thing I would urge you to consider if you are interested is to join our planning for next calendar, not calendar year, I'm sorry, academic year coming up. And if you are maybe thinking that rather than being active, but you have some ideas of what we should do, please do post your suggestion in our LinkedIn group. We will have a survey going out soon to get some of your feedback. But most of all, I'd like to encourage everybody to be engaged in this community building. And if you want to get in touch, you can either contact one or me at our email address. So if you have attended other webinars, you know that mostly we have been having 3 speakers, social entrepreneurs, sharing their experience. And today is special because we only have 1 speaker, Rob Terenzi, from who is a CEO of Vega Coffee. This is has been one of our most popular webinar, and rightfully so, because negotiating terms and taking into account all the legal issues associated with starting your enterprise is so very important. And let me stop sharing. And Rob is absolutely the perfect speaker for this, because not only is he a social entrepreneur, having started Vega Coffee and have gone through this whole process himself, he was also a corporate attorney for Wilson Sonsini, a premier law firm in Silicon Valley, where he advised both investors and startup companies in negotiating formation of companies and how to get to rounds of financing. So in terms of logistics today, Rob will give his seminar on all the legal issues associated with what you need to know as a social entrepreneurs, and then we will take questions after. But you do have the question button at the bottom of your Zoom screen, so please feel free to enter your questions as we go, and we will address them once Rob is finished with his formal presentation. So let me turn over to Rob.
Hi, everybody. Nice to see you all. Thank you, Sayuri. I appreciate the introduction. Yeah, so I thought that today, as far as an agenda goes, I would kind of introduce myself and my work history and my work with Vega. Then kind of talk about basically the process of building a company legally and the implications of doing so. So talk about a little bit incorporation and entity choices there and how it affects your fundraising choices later on. And then walk through kind of briefly the main fundraising choices and instruments available to startups and kind of the pros and cons of each. And end with just kind of some main takeaways that I think that are important to kind of leave here with that aren't necessarily the most intuitive things. So first, I am Rob Terenzi, founder of Vega Coffee. Right after undergrad, I went to Nicaragua for about 3 years and worked with coffee farmers with a small nonprofit, and became really kind of amazed and fascinated by the coffee supply chain, and specifically by just kind of how broken it was. Farmers typically earn less than $1 a pound for the coffee that they sell. And that's because they're exporting a raw commodity rather than a finished good. And so one of the things that I did in my initial kind of time in Nicaragua, and this was like 2005 through 2008, was basically start a smaller version of what Vega ended up being by giving farmers like the tools and training to roast their own coffee. And we sold it domestically in Nicaragua. I ended up leaving that and coming back to the United States to go to law school, where went to Fordham Law in New York City, and got a master's in economics kind of at the same time as my law degree. And the whole time was kind of maintaining contact with Nicaraguan farmers, led a bunch of group trips down there, and just coffee was really kind of a part of me. But I didn't see necessarily a clear future as a career there. So became a corporate attorney in Silicon Valley with a firm, Wilson Sonsini, Goodrich & Rosati. Under my main partner that I worked with most closely was a guy named Joachim Taku, who is kind of one of the first attorneys to really lead the way in democratizing legal advice and kind of open sourcing a lot of it. And his website, Startup Company Lawyer, is like an invaluable resource. Some of the information is a little bit dated because it's been a while since the kind of initial push, but it's all really valuable, all really foundational, and answers so many of the initial questions that founders can have when they start their company. So I'd really recommend visiting that website, doing the background research. At any rate, I worked there for about 4 years, handled hundreds and hundreds of venture financings, everything from a $20,000 convertible note to $1 billion merger and acquisition, and really loved being a part of the startup scene. It was also kind of my first exposure to like what's now popularly known as social enterprise, and kind of the idea that you can do kind of good and do well, ideally. And so about 4 years into being an attorney at Wilson Sonsini, I somehow convinced my wife and my good friend to all three of us quit our jobs and move to Nicaragua to start Vega kind of initially. Since starting Vega, we have raised money basically in every way possible. We've gone through crowdfunding, family and friends, notes, a Series seed equity round, revenue sharing, grants, working capital, resolving facility, fixed debt, as well as most recently like convertible equity. So I have a lot of experience on both the entrepreneur side and the lawyer side of kind of working through all those things. I think kind of the main takeaway that I think is a little bit unclear when you first start raising money potentially is that raising money and financing your company is an exercise in balancing control. And so whenever you take money from an investor, you typically have to give up some element of freedom or of control of your business. And it can be as kind of innocuous or as little as them requiring an annual update, to kind of needing to run every decision over, you know, $10,000 by your board and getting unanimous consent. And so what I'm like most fascinated about in negotiating financings is kind of what is motivating the control questions behind the financing. And sometimes it's that there's nothing specific about it. And so the standard set of like rights and responsibilities is good enough. And other times investors can be really worried about a particular facet of the business, and so want to exercise greater oversight or greater control over that specific point. Most kind of impasses in negotiating can be resolved by understanding what fear or what insecurity either the investor has or the entrepreneur has, and kind of working to resolve that kind of difficulty in understanding, because these are long-term partnerships. Unless you're doing kind of like a fixed debt 12-month, 50K in, 50K plus interest out in a year, any kind of like quasi-equity or equity financing is going to be likely last the entire life cycle of your business. So it's not only really important to choose the right investors and to understand their motivations at the initial stage, but it's also super important to set up the control elements for a long-term relationship and an increasingly sophisticated and complex relationship as new investors get involved. And so, like, before we kind of start talking about any of the nuts and bolts, it's really just kind of important to understand that like a financing transaction is about establishing control over the business and about giving up certain elements of control. That said, not all impasses can be solved easily. A lot of that can kind of starts with your lawyer. And so kind of choosing your lawyer and understanding the other side's kind of attorney situation is going to be really important at the outset. I'm kind of born and raised in the East Coast from, New York, Connecticut, but spent, several years on the West Coast. And there's a distinct cultural divide on attorneys between the East Coast and the West Coast, in my opinion. The Silicon Valley lawyers, I think, are on the whole faster, more innovative, cheaper, and like the documents are just shorter. I mean, as soon as you are dealing with a New York attorney, because you get 5 documents that are all 100 pages long. Whereas like Silicon Valley lawyers, I think, particularly in the startup space, prioritize using templates, using kind of off-the-shelf documents to like limit negotiating, limit kind of complications. So I really think that if you have kind of the option of using a West Coast attorney, and particularly if your investor is open to using a West Coast attorney, I think that those transactions, in my experience, always go much faster than when kind of New York lawyers get involved or Boston lawyers get involved. The other important distinction is pro bono versus kind of paid services. Pro bono attorneys, I think, like, and this was true when I was an attorney too, like you get into it with the best of intentions, wanting to help, wanting to do the best work you can, but paid work just inevitably takes priority. And so in my experience, working with pro bono attorneys has been kind of less effective, less efficient than paying attorneys. We've tried to do as much legal work as we can ourselves, but we will often, for discrete legal issues or where we're kind of required to get an attorney, we tend to prioritize getting paid attorneys, unless it's like a quick kind of advice consult thing. But for an extended transaction, it's usually worth it to pay an attorney. And in the Silicon Valley area, there's often a lot of arrangements, like deferred payments for a year, for 2 years. We did that often at WSGR and kind of assumed some sense of risk. But I think that those are important considerations, because my experience working with pro bono attorneys has been kind of less than satisfying. I think the work is just a little bit less rigorous, unless the shop is like specifically designed for like a social enterprise kind of clinic or something like that. It usually helps to pay for your attorney. That they don't have to be expensive either. Like we would always keep transactions for under like 250 or under 300K under 15K or 10K for our entrepreneur clients, because we could use templates, we could use standardized documents, and we could just kind of get it out. So don't necessarily assume that paying for a lawyer is going to be super expensive. Additionally, I think that something that affects the ability to fundraise and the speed at which you fundraise is your incorporation type. My general advice is to kind of stick to standard kind of vanilla corporate entities. So for a for-profit, it would be, a Delaware C Corp. And for, a nonprofit 501c3, that stuff's kind of clear. It's very rare that you need a hybrid entity to kind of affect the change or the business model that you are envisioning. Most business arrangements can be fit within kind of typical corporate structures. And when you think about the people that you'll be raising money from, the social impact investor spectrum is dominated by retired wealthy people who are kind of trying to do good and give back, and those they're a little risk adverse when it comes to corporate entities. And so, and especially kind of trying to figure out a diplomatic way to say this, but essentially like the older white male crowd that make up a bunch of the angel investors in the social impact spectrum want to invest in something that they know and they understand. And so keeping things simple, keeping them kind of in the basic kind of corporate structures, it will help you fundraise now and later down the line when you go for a larger institutional round. Upon incorporation, it's really important to just take care of the basics right away. So buy your common stock at par value before you kind of do anything significant that would kind of jeopardize the valuation of your company. File your 83B elections, appoint the initial directors and officers. You want to do this kind of before any fundraising, before anything else happens, because you lay the groundwork for a very easy and successful fundraising round when you have all of your basic corporate documents ducks in a row. If you kind of don't buy your stock and then your idea takes off and you're raising money at a valuation, then it gets harder for you to participate in that upside, because you've missed buying stocks at the low valuation that were represented at the time of incorporation. So again, startup legal fees should definitely be under $5K, $2,500, $3,000 if it's something simple and if it's not overly complicated with IP and pre-existing rights and responsibilities to your former employer, stuff like that. Like if you can just have a clean break from your former employer and start with a fresh slate, you should be able to kind of get all this stuff done really cheap and really effectively. And it'll be incredibly important for fundraising later on. The kind of brief overview of financing instruments. So when we started Vega, we started with the idea that if we could empower farmers with the tools, training, and market access to kind of sell coffee directly to consumers and to process coffee in the country of origin, we could keep a lot more money where the coffee's grown. So farmers went from earning, when we started, about 75 cents a pound to now they're earning close to $5 a pound with us. We export a finished good directly to the United States, sell it to a bunch of different kind of sales channels, and now have operations in Nicaragua and Colombia. Again, kind of on the incorporation side of things, we've been able to keep that very simple by creating wholly owned legal subsidiaries in Nicaragua and in Colombia that just the founding member is Vega Coffee Inc., which is a US-based corporation. And that's like very simple, it's very easy, and it's very clear for investors to understand. When we started, we had the Nicaragua corporation and the US corporation, and launched a Kickstarter campaign in like late 2014. And as far as like onerous kind of obligations, crowdfunding is going to be the least onerous. You don't actually owe any legal responsibilities to people who back your campaign in Kickstarter or any kind of those platforms. If you launch like your own crowdfunding campaign through I think it was the Jobs Act. There are a number of federal filing requirements that are pretty onerous and pretty difficult. So I would suggest kind of using one of the platforms just for ease and for legal compliance. After kind of crowdfunding, you can, the next least onerous kind of from a legal perspective would be a grant. For-profit companies can receive grants. Sometimes they have to find a sponsor organization. So we got a grant to expand to Colombia from the Linked Foundation, but it had to go through Mercy Corps, which was an investor of ours as well, because they could satisfy all the reporting requirements needed. And so when you get a grant, there's usually a very limited scope of things you can spend the money on. So it has to be an itemized budget, and there has to be reporting, and there has to be reporting on the effects of the spending. So in that sense, it's a little bit burdensome, but it's free money. There's no equity control. There's no repayment obligation. And so grants can be a great way to kind of test out new kind of high upside on the impact side of initiatives, but perhaps a little bit riskier from a business or cash use perspective. Next on down the line would be debt, and I would break that up into kind of fixed debt versus a working capital revolving line. We have both of those kind of right now. This will be the kind of the diligence process and the legal documentation attached to this is going to depend on the source of the financing. So we got some equipment paid for via a loan through 2 individuals. That was a very streamlined process. It was basically like a 3-page loan document that said, here's $80,000. We expect to get paid in 2.5 years, and you don't have to make any payments for the first 6 months. If anything goes wrong, we own the piece of equipment that you bought with this money. So very, very simple process, very fast process, and we essentially took interest rates from like existing documents that we had. On the working capital line, that's basically saying, here's you have access to up to $250K, and you can take it out in tranches, and then as you pay it back, you unlock more capital. And so we basically use it to buy green coffee in bulk at the beginning of the season, pay it back as we sell the coffee, and then borrow again when we need to buy a bulk of inventory the following year. So none of those items are going to require a lot of thought about control, except for the kind of a fixed debt where you can't sell the piece of equipment that you bought with our money without paying us back. Where you get kind of into more interesting and complicated relationships are going to be things that that are more closely aligned to equity. So things like convertible debt, convertible equity, revenue sharing, kind of demand dividend, and then straight equity are going to be the most kind of typical options on that side of financing. The kind of the most classic or fastest way to get money into a business kind of after its initial incorporation is going to be via a convertible note. These became really, really popular at kind of the late 90s, early 2000s, when there wasn't a very clear mechanism by which we could value companies, particularly startups coming out of Silicon Valley, because their valuation changed so drastically, so quickly. So instead of having a valuation conversation, which basically means if an investor gives you $100,000 and they value your company at $1 million or 900K pre-money, then after they give you the money, your valuation's $1 million and they own 10% of the company. Those kind of conversations about valuation can be very contentious and can be very subjective, especially at the early stage. So, when a founder starts a company, they're going to think that it's worth $10 million the minute that they kind of sign incorporation paperwork because their idea is so good and the team is so strong. An investor is going to think it's worth 200K because the team's strong, but the idea is completely unproven. To kind of bridge that gap in expectations and make sure the company gets funded and can move forward, the kind of convertible note idea was created as a means by which to put off the valuation conversation. So you typically include a valuation cap, which means that if the company at the next financing round, so the next time people put money into this company, is worth, say, $5 million, our valuation cap when we invested in you was $2.5 million. So we are going to convert the money that we put in, not at the $5 million that everybody else is putting in, but at the $2.5 million mark. So we get the benefit of taking a risk earlier on, even though we did not set a valuation for the company. That proved to be really effective. However, kind of over the last 10 years, the fiction of it has gotten a little bit more burdensome. So by that I mean convertible debt comes into the company as a debt instrument with an interest rate and a maturity term, but neither side really expects to get paid back. They expect the company to raise money and for it to convert into equity. That's the whole point. The investors coming in don't want just to get their money back plus 8% in 2 years. They want to convert into equity and participate in the upside of the company that they believed in at such an early stage. And so this idea of convertible equity kind of emerged. And that most typically takes the form of a safe note. What this does is essentially say, we're going to put $200,000 into the company, and we're going to have a valuation cap. We're going to have a discount. So even if the valuation cap doesn't get hit or whatever else, we get a discount on the price of equity when you guys raise money next time. There's none of the fictions of debt attached to it. So there's no expectation of getting paid. There's no interest rate, and there's it's on the balance sheet more clearly as equity than as debt, which allows for companies to raise kind of working capital debt and things like that. So the convertible equity now, I would say, is kind of well accepted as the best way to get money into a company early on. It does require a little bit of sophistication in the investors, because most investors are probably more familiar with convertible debt. But the kind of mechanics of each don't change greatly. It's usually a very fast document. It should only be about one document, sometimes two if you're issuing multiple notes. Just a couple of pages. Key terms being valuation cap. So what's the maximum that we'll accept when this converts to kind of convert our existing investment into equity at. The discount. So if the next round of financing comes in at $1 a share, we only have to pay 80 cents a share or 70 cents a share for that conversion. And then if you're sticking with debt, it's going to be a duration, so the time, so 2 or 3 years. The truth is that if you get to a mature convertible note and have not raised equity yet, you probably have to have a conversation about the expectations with your investor, because there's likely not going to be the cash in the company to pay back the debt if you haven't raised enough money to convert it. And you're probably on a slower growth timeline than expectations were at the beginning of at the time of the investment. There's not a lot one of the big takeaways that I would say kind of coming out of this is that to the extent that you can use templates or off-the-shelf documents, that's going to be by far your best option. And that's not only for your peace of mind, but also the investor's peace of mind. So, using the standard safe note, we'll kind of signal to the investor that I'm not trying to pull anything. You're not trying to pull anything. These are universally agreed to kind of control mechanisms at this point in the company. They're streamlined. So there's not going to be a lot of negotiation over kind of legal terms, which like is kind of the point at this stage. When you want to really negotiate the levers of control and participation by investors is when you kind of raise a full institutional round, a full equity round. That's when that's when the stakes are going to be higher. There's going to be more sophisticated attorneys on both sides, and the transaction cost relative to the investment amount is going to be kind of more in line than if you try to spend a bunch of money on legal negotiations when you're only raising a couple $100,000. I think that there's a lot of meat there, so maybe I'll come back to that for the questions if people have questions about the convertible, the mechanisms of conversion. The basic idea there, though, is that because it's a convertible instrument, the investor does not typically have any voting rights unless they've requested a board seat until the conversion. So it gives the company a lot of flexibility and a lot of nimbleness to not have to get stockholder approval that includes investors on every kind of major decision or thing they're doing, unless those things are kind of outlined and delineated in the term sheet or in the binding final documents. The kind of next level of funding, I would say, would be a revenue share or demand dividend. This instrument basically puts money into the company with an expected repayment schedule based on how much revenue or profit the company is generating moving forward. These can be really effective ways to get money into the company and really effective ways for investors to get their money out of the company. Investors who invest on like a demand dividend or revenue sharing are more likely kind of looking for just a round trip of capital rather than a home run. So they're not participating to the full extent in equity of the company. So their incentives might be a little bit unaligned with the founding team. Essentially what they're saying is, I'm going to put this money, I'm going to give you $100,000, and every 6 months for the next 3 years, you're going to pay me, 75K or whatever it is, so that at the end of the day, I get 2.5 times my money back, or 3 times my money back, whatever the situation is. These instruments, I think, are complicated. They put a lot of stress on the company's accounting, especially if you're kind of doing a profit sharing rather than just a straight revenue share, because then you have to determine what is profit. And while I think that the pros of them are that they've been really good for the impact community in getting capital into companies. And getting it back out so that investors can make serial investments. One of the things that I've seen is that it does put cash stress on a business at an early stage. So unless you're very comfortable with kind of the ebbs and flows of your cash situation, a demand dividend or a revenue sharing can be somewhat dangerous to your cash position. Additionally, you need to work with investors who really understand your business. So if you're in coffee, you want investors who understand the agricultural kind of harvest cycle and the sales cycle so they'll understand when you're going to have cash available and when you need to tie it up in inventory. Additionally, one of the risks I've seen is that it can be discouraging to later stage investors or following on investors, because no investor wants to put money in just to have it be used to pay off existing investors. The rule of thumb is that the last money in is going to be the first money out. So the latest investors are going to want to be prioritized for investing and want to guarantee their payment before kind of earlier investors. That said, with cash kind of flow understood and incentives aligned, I've seen this work really well where companies will say, okay, you'll get 2.5x your money back unless we achieve these 3 impact metrics. So if we reach 1 million farmers, get 50 kids in school, or whatever it is, then that number goes down to 1.5 times or 2 times, so that there's incentives to maximize the impact for both the investor and the entrepreneur. Finally, kind of the most onerous kind of set of documents is going to be a full equity raise. If you're raising anywhere kind of under $3 million, Series Seed is probably going to be your best set of documents to use, because they're widely accepted as kind of streamlined equity instruments. And there's very little kind of negotiation to do once you kind of agree on the fundamentals like valuation and whether the investor can participate. That said, if you go for a full investment, kind of it's made up of 5 pretty meaty documents that can take a long time to close, a lot of diligence involved, and kind of basically, I would suggest kind of holding off on raising equity for as long as possible, not only because you want your valuation to be as high as you can to limit the dilutive effects of incoming equity capital, but also because from a just time perspective, it takes a long time to close an equity financing, and it can eat up a lot of legal dollars. That's kind of like the overview. I'm mindful of our time because I want to give enough time for questions. Essentially, like the takeaways that I would suggest are that financing is, as I said, like an exercise in control over decisions in the business. And so understanding motivations and understanding what investors are worried about with your business is going to be super important. The extent to which you give up control is going to be determined by kind of how fast you need the money, your bargaining position relative to kind of how many investors there are, who your lead investor is. So if you have a really quality lead who prioritize getting the deal done, that's obviously going to help you. And then the instrument by which you arrange the financing. At the end of the day, you want to stick to basics, stick to templates. There's like no shame in kind of doing something just totally vanilla and straight down the book, by the book, because as more sophisticated investors come on in later stages, the easier and simpler your current legal documents are, the easier kind of the future transactions are going to close, and the less negotiating with existing investors you're going to have to do. Yeah, I think I'll pause here and maybe take some questions if we have any.
Thank you so much, Rob. We do have some questions, so I will read them. And by the way, you can see them as well at the Q&A if you open that up.
Oh, perfect. Yeah. Okay.
Yeah, but I'll read them out for the audience. So the first question is, do you have any recommendations of attorneys that are well-versed with working with social enterprises, both for profit or for purpose on both coasts?
Yes. I can probably send emails and contact information after this is closed, but Blue Dot Advocates, they're actually based in Boulder, Colorado, but they have a couple of people from WSGR, and then one of their attorneys based in Austin, Texas, and they are really good. And Brian Mikulanchik is a tax attorney who understands nonprofit tax, social enterprise tax in ways that are really, really interesting and kind of engaging. And so, yeah, I would say Bruce Campbell from Blue Dot and Brian Mikulanchik, and I can write that after this.
Yeah, and just so everybody knows, Rob has, I guess, notes or slides of content from this conversation. So he is going to share it with the audience as well. So we will be posting those through LinkedIn and through the alumni site, and we'll make sure to include that information there as well. Okay, so the second question is, can you tell us more about how Mercy Corp, 501c3, became an investor in your for-profit venture?
Yeah, so Mercy Corp actually has a separate entity called a social venture fund that makes investments of, I think, up to 500K in for-profit companies, doing kind of through like a PRI program, so a program-related investment, where they can write off a certain amount of growth or loss on our company through this venture fund. But it's a great fund, and they've invested in a bunch of companies in Colombia and in other parts of the developing world. And so basically they had a program in Colombia working with women coffee farmers. We wanted to expand to Colombia, and so we kind of negotiated this deal where they would invest in us and we would get a grant that matched their investment to kind of help fuel the pilot in Colombia.
So can you also mention a little bit about foundations and some of the ways that nonprofits can participate in investing in social ventures?
Yeah, so I think that there's, I think it's going to be region specific, where, we haven't had a foundation directly invest in us at all. We've had besides in Switzerland. So there's a Swiss foundation called the Alea Foundation that did make a direct investment in us via convertible equity. However, kind of the other ways that we've gotten money from nonprofits is they've had another vehicle that's been like either an LLC or something like that that has made the for-profit investment. That's kind of what we did with the Link Foundation had a separate entity. Mercy Corps has a separate entity. The only one that isn't like that is the Swiss Foundation, and that's apparently has to do with Swiss banking laws, where they're allowed to make kind of for-profit investments, from what I understand. But yeah, I mean, foundations have been super important to our work, both in providing mentorship and kind of just funds. So whether it's a grant or kind of one of these quasi-equity investments, foundations have been very important because, you know, they're tend to be more patient with their capital, tend to kind of want to maximize the impact side of things and invest in impact, which it can sometimes be hard to find for-profit investors who want to invest in impact, and typically have had pretty broad networks where once you have a relationship with them, they can kind of introduce you to the people who fund them, which can be really helpful to finding other new investors as well.
Okay, the next question. Could you say again what documents, templates best to use for a seed equity raise? Are there any templates you can recommend?
Yep. So it's just seriesseed.com. It's going to have your 3 basic documents that you need. And those are going to be, they're just incredibly streamlined. They're really hard to mess up. So if you fill in a couple of like blanks, it kind of auto fills the rest out. And if you do a track changes against the template, when you distribute to investors, you can show that you've made very minimal changes to the form documents, the template documents, which kind of generates confidence and comfort for everybody. But yeah, the Series C documents are just, they're very clean and very, very easy to use. You almost don't need a lawyer for them, but I don't want to say that, so.
Okay, Rob, the next question, by the way, says, thank you for being on. What are some common mistakes that early founders make, and how can you avoid them?
Yeah, I think a couple of things. One is not ending previous employment cleanly. You know, if you are starting a venture that's at all in the same space as your previous employment, you want to make sure that you've kind of spoken to a lawyer, you protected your IP, and you didn't do work on the new company, you know, using company materials or on company time, because then they can lay a claim to any IP that you've developed, you know, while the time's overlapped. So I think ending employment on good terms and with a very clear kind of separation agreement is incredibly important. Waiting, if you have multiple co-founders, waiting too long to determine kind of levels of ownership is very harmful to kind of founder relationships, because let's say, you know, there's 2 people, one of them comes in with all the IP and thinks that he should get 75% of the company. The other guy, you know, they don't have that conversation. And then the second guy is doing like way more work than the first guy did to start. And then before an investment, you start to talk about who owns what. That's going to delay investment. It's going to make your relationship murky. So I think just determining that upfront, whether it's 3 equal partners or, you know, this person brings in a little bit more, so we want to reward them with a little bit more, but establishing ownership and titles early on is really important. And, you know, titles is tough. Like that's something we didn't do very well initially, because the 3 of us, I founded the company with 2 co-founders, and we all wore so many different hats initially that it's hard to kind of specify that. But you know, that's so important when you're talking to investors about who's handling what in the company. And so I think like founder agreement early on is incredibly important. The third one is kind of more of a technical one, whereby the typical kind of equity structure when you start a company is to kind of buy common stock that is restricted, so it vests over a period of time. The classic is 4-year vesting with a 1-year cliff, and then monthly thereafter for the remaining 3 years. As soon as you buy that stock, so you know, you buy 3 million shares for $30 or something, because you're buying it at par value, or extremely low value. you need to file what's called an 83B election within 30 days, which basically says, I'm paying all this, the kind of tax on this up front, and there's no tax on something like that. So if you don't file that, then you have to pay tax as the stock vests. And if you, not a problem initially, but if you kind of jump from a $1 million company to a $10 million company and are realizing a vesting every month, you're gonna have to pay taxes on that without having any incoming cash. And so an 83B election within 30 days of buying your stock is kind of the most important. There's like not really an easy way to remedy a mistake on that. I think those are the three biggest kind of things.
Okay, the next question. Would you recommend incorporating before talking to investors at all?
I definitely would. Incorporating is easy. You can do it on Zoom, like legal Zoom. Like it's a really easy process, and it just gives you a baseline of accountability and allows you to do things like buy your stock before it's worth anything, as well as like set some ground rules. So I would definitely. I mean, it's going to depend on the business as everything, but I would having a corporate form in place before fundraising is really important.
Okay, next question. How do you manage timelines when some investors have committed and others are on a slower timeline in terms of interactions with both sides?
Yeah, this is like something we've struggled with so much. The kind of the kind of like common sense answer here is to say like, hey, we have 50% of what we're raising committed. We're going to close in 30 days. You're either with us or you're not going to participate in this round. But in reality, and especially in the social impact space where people move a lot slower than in Silicon Valley, on average, sometimes that just doesn't work. And so we've had closings go on for 6-7 months at a time, just waiting for people to wire, waiting for people to kind of get comfortable with diligence materials. We've, lost out on investors because of that. Most recently we had an investor kind of like pull out because of kind of the effects of COVID on their business. So, I mean, you want to close as fast as you can with it and get as much capital in as quickly as possible, but sometimes that's just not possible. And so, a lot of it's going to depend on your bargaining position. If you have an oversubscribed round, then it becomes very easy to say, if you don't fund by March 31st, we're going to let other investors participate. But to the extent that you're just kind of piecing together commitments and investments, sometimes that process just drags on, and it's a drain on everybody's time and everybody's resources, but sometimes that's just how it works, I guess.
Okay, the next question. Can you say a bit about LLB versus LLC for social entrepreneurs?
I can't say a lot about this because it's not it's not like a corporate entity that I'm particularly familiar with. In Silicon Valley, we did pretty much everybody with C Corps. Like LLCs were extremely rare. We were kind of one of our biggest investors, a real estate investor. And so he really wanted us to incorporate as an LLC because that's what he was comfortable with. But because of like tax implications and preferred stock, kind of the ability to manipulate preferred stock and the rights of those, like my experience is almost entirely with C Corps rather than kind of member managed arrangements or limited liability kind of entities. So I'm sorry, I don't have a lot of experience with that.
Okay, the next question. On that point, also from investors' perspective, I'm not sure I understand this question, but please check your employment contract to ensure the scope of non-competes. Because maybe this is a comment rather than a question.
Yeah,
I mean,
right.
yeah, go ahead.
Yeah. I don't know if it's kind of saying that the investors have responsibilities before they invest in companies if they are subject to non-competes as well. But yeah, I mean, that would definitely be true. Yeah.
All right. Hey, you've got Rob on the line here. This is the last question I see. If you have any other questions, get it in before, I guess we have 10 minutes. Maybe I'll ask Rob a few questions while we'll see if there's any other questions. I guess, what do you think about incorporating not as C Corp, but as B Corp? I mean, I guess some people think that there's, maybe you can talk about pros and cons of that approach.
Yeah, I think, so I think that the pros of being a public benefit corporation, or, you know, kind of using a corporate entity, because it's going to be state dependent, kind of, that is kind of more adaptable to the B Corp model. I think some of the immediate benefits are that you get access to a really good network of other entrepreneurs, other investors, and other kind of entities that are looking to invest in companies that kind of subscribe to that model completely. I know for a while, B Corp wouldn't certify you if you didn't pick up that specific kind of corporate model. I think that they might have relaxed that a little bit, but you know, if being certified B Corp unlocks business opportunities, which I think it does, investor relationships that kind of like, that's in their kind of profile of criteria they look for in companies, then, you know, I think that it's probably worth it. The B Corp and the, you know, benefit corporation structure is, you know, it can be a little unfamiliar for investors who don't know a lot about it, who are, you know, scared about kind of not putting shareholder interest first. I think that the necessity of it is kind of like unpersuasive in some ways, just because you can do a lot of things under a C Corp that are technically in the company's and in the shareholders' best interest, that aren't just about maximizing profit. You know, that there's like a long line of case law going back to, you know, Henry Ford that establishes those principles, and especially when you are a stated social impact company, and so the investors getting involved understand the risk and understand you know, what the purpose of the company is. There's not a lot that you're limited from doing in a C Corp that you are able to do through a B Corp. That said, you know, I really think that the benefit of the B Corp and that model is unlocking networks of capital, of business opportunities, of partners that kind of follow a similar mindset and a similar ideology as your business does.
Okay, we have a bunch of new questions that came in. The next question is a different kind of negotiation. How did you go about motivating and convincing people to uproot their life before your company is real? So,
yeah, I mean, essentially I pitched it as a 1-year sabbatical. And so just give it a shot. And then we kind of kept raising money. We kept kind of, you know, doing more and more, and it became more and more robust. And so that ended up, you know, turning into the last, like, basically 6 years of my life. I think that as far as like that's kind of like the team angle. One thing that we were mindful about when we went to Nicaragua was like not promising the moon. So you're working in economically vulnerable, you know, communities. They're used to kind of nonprofits, you know, people coming in saying that they're going to change their lives and then leaving after a year or two. So, you know, we made the promises really small when we started working. And then with our investors, we've had a lot of luck at SOCAP, finding investors who believed in us before, you know, we were able to export coffee. Yeah, I don't know. I think it's about communicating the vision, communicating the impact, and kind of taking it off in small chunks, like saying like, hey, if this doesn't work in 6 months, if we're just hanging out in Nicaragua for 6 months, is that really the worst thing in the world? We can come back to our jobs maybe. And so, yeah, so we did that. And, you know, something that we're really proud about is that all of the lawyers that I worked with in my group have all invested in Vegas since we left. So I kind of always knew that I could go back to being a lawyer if I needed to, but I'm, you know, happy that I haven't had to so far.
Great. Couple of questions about whether or not this webinar is being recorded and will be available later. And the answer is yes, it's being recorded. and it will be on the MIT alum YouTube channel. And that information will be sent out to everybody that is registered when it becomes available. It also will be shared on LinkedIn and the alumni site. So let me just answer that. The next question is, has the funding environment for startups, okay, it moved.
During COVID.
Yeah, during COVID, changed significantly.
Yeah, I mean, I think that it has in a couple ways. One is that, yeah, I think as I mentioned, we had an investor who's particularly hard hit by the COVID crisis. So I think that people are looking at more uncertainty over the next, I don't know, I've heard as long as 18 months. I hope it's not that long. I think that if your company happens to be working on something that directly affects kind of response to COVID, like there are new funding opportunities available to you there. There's, certain investors have like emergency bridge funding for portfolio companies available. So if you have a relationship with a well-established investor, you could be in an okay situation. I also think that the government money coming in, so PPP, EIDL, if you can get access to some of those funds, that's some pretty cheap capital. So that's kind of on the kind of upside. Like the PPP, to the extent that it's not forgiven, it's only a 1% interest rate for 2 years, and so that's really cheap capital. But yeah, I mean, I think the kind of like the angel network. I mean, we were in the middle of raising a bridge that kind of hasn't been able to be completed yet, and so I do think that it's changed. I'm hoping that it's just like the next few months, and then people kind of get comfortable and kind of we can resume our normal fundraising activities. But I don't know. Yeah, I mean, it's definitely drying up a little bit.
Okay, next question. Hey, Rob, what is the biggest mistake you have made in the capital raising process?
An anonymous attendee too.
Yeah.
Let me think. One of the rounds we did, the opposing counsel was a New York firm and was not comfortable with letting us kind of represent ourselves because they thought that like founders got too passionate about their business. And so even though it was a pretty simple fundraising, instrument, they wouldn't let us kind of manage it. And so we had to bring in an outside counsel, and I kind of wish I'd fought harder on that, because there's definitely no ethics rule or anything like that about why we wouldn't be able to represent ourselves. And it significantly like prolonged the transaction costs and the time of waiting. So I think there's that. I think that would be the biggest one. Yeah. And actually this one's important. I think we set our initial valuation too high. That's kind of dogged us for a while on subsequent rounds of financing, because our initial kind of valuation cap was I think a little too aggressive. And so, you don't want to take a down round. You don't want to dilute everybody. And so I would just kind of be realistic about your initial valuation cap, your initial valuation, because it will affect follow-on rounds.
Okay, the next question. Who do you recommend individual employees talk to early exercise options and lower tax burdens? Is there a
I'll send the contact for this. This is my friend Brian Mikulanchik in Austin. He's very, very good with this stuff.
Okay, great. Next question. You mentioned grants earlier and how another company had to meet reporting requirements. Could you speak to grants again, if any company can receive one with low overhead?
Yeah, I mean, it's going to depend upon the kind of the structure of the nonprofit that you're receiving the grant from. Some of them will kind of be standalone entities and able to take a little bit more risk, and some of them are kind of like as big as Mercy Corps, and they have all these stakeholders to report to, and kind of reporting requirements that are very rigorous, and so there's definitely grants and kind of sponsorship opportunities where you can kind of fold yourself underneath an existing nonprofit and receive a grant in ways that are really fast and simple. It's just, you kind of have to kind of, it's something most nonprofits will have kind of listed very easily, like what's your criteria for receiving a grant or for giving a grant, and what do I have to do to kind of comply with your regulations. So I would just have that conversation early on.
Hey, this is going to be the last question for the webinar since we're gonna run out of time. But if you have any more questions for Rob, please put them into our LinkedIn site and I'll collect them and ask Rob to answer. I guess I should ask Rob first if that's okay, but I'm gonna think that he's okay with that. Okay, here's the last question. What have been the biggest challenges in the business model of taking out the middleman and going direct from farmer to consumer? Did you also have to become an importer? I'm creating a similar model, but for a very different market. So I am very interested in hearing your lessons here.
Yeah, happy to kind of connect offline too, but essentially we became registered importers, exporters, certified by the FDA, USDA, Homeland Security, the Nicaraguan and Colombian versions of all those entities kind of across the board. I think that the hardest part for us has been, we had a very clear model for the supply chain and a less clear one for the sales side. So developing a really innovative sales solution and distribution model at the end has been the kind of most business challenging thing once we kind of figured out the supply chain in Nicaragua.
All right. This is concludes our webinar today, and thank you, Rob. I guess this was such an amazing advice that you're giving to our community, and we really appreciate your time.
Yeah, of course.
Okay.
Barry.
Bye for now.
Thanks for joining us. And for more information on how to connect with the MIT Alumni Association, please visit our website.